And the theme of our show is, again, Tony Walker Financial is more than just annuities, but kind of speak to the fact of how we've merged these two worlds together, the investment world, and in the earlier segment I talked about how long I've been doing investments, and the annuity world. So, Trey, we've created something called the Split IRA. Do we have that graphic? That's what I'm looking for. So, Trey, speak briefly to this Split IRA and this merger of our expertise with the Schwab Bucket and the Annuity Bucket, and from a planning perspective, how this benefits our clients.
This graphic alone has really helped our clients understand how divided the world of investments has been for decades. And what I've noticed, especially in the last 3 years being more on the front end with onboarding, is all these folks come in, they're either in one world or the other. They have annuities with no plan or investments with no plan. And if you can put the two together and provide them expertise in how to use them with a game plan, it's a game changer.
And Wes, I know you've got some statistics I'm going to ask you to read. That Schwab Bucket is imperative. What are you seeing out there as you're getting more used to how we use our investments in terms of planning versus, let's say, a money manager that's just trying to grow their money, and how much money we distribute to our clients to help them use and enjoy this money? So in your mind, what is the purpose of that Schwab Bucket over there?
As a traditional money manager would be primarily concerned with growing your assets, they'd have a longer time horizon, the ability to take a little more risk. We're taking that money that's been grown over a period of time and we're distributing it back to clients because most of our folks are nearing retirement, they're at retirement, and they now have a reason to actually pull this money out of the accounts. So it's really just a different frame of reference. Just to kind of speak to that, we have currently about $221 million of assets under management with Charles Schwab. And last year, so all of 2022, we sent out about $23 million of distributions. That's not annuity purchases, that's money that's gone directly to clients to use and enjoy.
From the Schwab Bucket, right?
Correct, yeah. So just those initial distributions that have gone from Schwab to the client, roughly $23 million last year went to them. Up to June 30th of this year, we're at about $12.5 million. So this is something that we consistently monitor, and we do make sure that these clients can use, enjoy, and spend this money from Schwab.
And Trey, again, you meeting a lot of people on the front line, especially when they're onboarding, I think it kind of surprises them. I guess it's the live well, die broke philosophy we have, but that we are so encouraging of them to take this money out.
Yeah, it is interesting. A lot of people have a lot of trouble going from saving to spending. But when you reach retirement age, you need to supplement the income.
That's why you save the money, right?
That's what it's there for.
Yeah, it's funny. We got another. Let's go to this next graphic. This is pretty cool here. And I'm going to let you tackle this one, Trey. We call this kind of the 4 needs of money. But I think, again, speaking to Wes's point, the difference between a retirement planning specialist like us is not only getting the money back to them, but what's the most efficient way to get it, and from which file drawers do we get it? You talked earlier about some unexpected things that come up. This really tackles this. So describe this 4 needs of money.
Yeah, so basically as we plan for these clients, they're coming in with different goals and objectives. We really kind of boiled it down to 4 different types of assets, whether they have cash in the bank, the Charles Schwab accounts, fixed annuities or indexed annuities for accumulation, as well as that mailbox money on the back end. It really kind of boils down to why we have a game plan in our income software.
In fact, let's put this up there. I mean, this has been a game changer for us, and I think for clients too, if you can put up the income software, Derek. I mean, this allows us to see things. We've had more people come in lately. I don't know if it's just a rush on, and they're very dismayed. They've got advisors they've been with for years, but they can't figure out why they're worried. And every time I say, can I see your game plan, and they don't provide one, I say, well, I'd be worried too. How are you going to know how to spend this money? So speak to the fact, especially when you all are delivering these binders, people are now clients and you can get to reference these from a planning standpoint.
Yeah, we can very quickly go to a specific tax year or age and explain how we're supplementing pension, Social Security, whether it be with cash or Schwab distributions, even penalty-free withdrawals from annuities. We can have the foresight to pull this up, look at any given year, and then work back on an annual review and say, well, we're ahead of schedule. This is what we're looking like.
Yeah, we talked about the 5th step of our process, monitor your progress. I mean, Wes, as you're getting more and more into this, especially with investments, I mean, where would you start, or where would you tell people to start without a game plan?
I really don't know. I mean, I think the typical Wall Street or financial world answer is the 4% rule, not getting too deep into it, but you take a lump sum and you withdraw 4% per year. There is no written plan. I mean, if the market falls 20, 30%, and they're in some pretty equity or stock-weighted portfolios, they could do that. If you fall 20 or 30% in a year and then withdraw 8%, how to project out what you're going to withdraw in 10 years is nearly impossible.
That's a good point. So as we put up our graphic on how we marry these together, I want to turn back to you, Wes. And again, you're just doing a wonderful job kind of overseeing investments. Now, we got to give kudos to Shannon Ross and Juanita Jackson, and now Keith Fuqua's coming back. Just that whole team of folks, Heather Hughes. I mean, y'all are doing a wonderful job in that department. But let's focus on how we kind of look at the money differently. Let's explain the 3 strategies we use. So, Derek, if you can go ahead and find these 3 strategies.
Right. So we have 3 strategies that we manage in-house. Now, there might be things that are different than these 3 strategies depending on someone's situation, but for the majority of our clients, we have 3 strategies that we manage: conservative, moderate, and growth. A lot of it depends on their risk tolerance as well as their timeline for when they're going to need the money. Starting off with the first one, conservative, it's really not going to be very volatile at all, at least we hope. It's mostly going to be fixed income instruments, shorter duration bonds, things that can pay an income but don't move around too much. If someone from the Wall Street world really looked at our portfolios or our strategies and commented on them, they'd say these things are so, all brakes, no gas. They don't go anywhere. But with the mentality of our clients, that's what we have to have.
We're working with savers,
we
right?
are, yeah. And they don't typically work with those kind of people. I think the worst thing that can happen is you get put into something you're not comfortable with, the market falls, and then you sell at the bottom. That really is a recipe for disaster. So moving back to the strategies, conservative, maybe 20% up to that in
Maybe
stocks.
put the moderate up there. So we're getting a little more in equity here. So if somebody wants a little more risk, a little more growth.
And they might be on the younger side too. They might have more time until they need the funds. So 45% can be in moderate in equities or stocks, and then moving along to growth, we can have up to 70% in the market.
Growth, share that, Derek. And again, folks, these will change. That's what we do, is pick different investments. But you can kind of see. By the way, what's that risk score of 54 equate to if somebody says, well, how does that compare with the S&P 500?
Yeah.
If you were to run that through the same scoring system.
It's an educated guess from a software that we use to gauge risk tolerance in different strategies. But the S&P 500 would be considered a 72 risk on our most aggressive.
So that's our most aggressive, is still below the S&P.
Correct. Yeah. And it's really an educated guess. It's not a perfect amalgamation of how much risk is in a portfolio. They're using back testing, but because we're not going to be taking inordinate amount of risk with our clients' money, we're going to fall below what even the market would be.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips, and be sure to hit that like button and that subscribe button for more videos.